afternoon, everyone. Thank you very much for joining us today. Welcome to the BPF Futures webinar, where the invitation has also gone out to the young professionals arm of the Commercial Real Estate Finance Conference, and also all BPF members. So if you're not a Futures member, welcome as well. Today, we've got a really great panel together, and we're asking you to imagine what would you do if you were or are a real estate investor. You might already work for one. In fact, I do, and I'm very much looking forward to learning from our experts today. So as I say, I work for Aviva Investors, and I head up the UK and Irish real estate research team. We're one of the largest real asset platforms with around 50 billion euro invested in infrastructure debt, equity, real estate debt, real estate equity, and also real estate long income. My role at Aviva Investors is to try and think about the future and understand the future investment landscape. So we've got a great panel here today. So I'm going to ask Catherine to introduce herself first, please.
Thanks, Johnny. Welcome, everybody. I am Catherine Fearnhead. I am a real estate partner at Adelshaw Goddard. We are a law firm, and we advise all sorts of investors as well as developers and tenants of logistics units. And today I'll be talking about logistics in a role as co-heading the logistics subsector here at Adelshaw's.
Very good, thanks. And over to you, Ashley, please.
Yeah, thanks, Jonathan. Hi, everyone. Thanks for having me. So I'm Ashley Seymour. I'm a chartered surveyor and a senior development manager at Assura. So Assura is a FTSE 250 listed real estate investment trust and a developer which specialises in primary care. So primary care, you might think GP surgeries, medical centres, primary care centres, health and wellbeing centres. They're basically all the same sort of thing. We own about 600, just under 600 medical centres across the UK. So we're landlord to GPs and NHS trusts, along with pharmacies and dentists and so on. And we see our role as being sort of kind of key long-term property partner to the NHS. And our mission is to create outstanding spaces for health services in our communities. And part of my role is to help develop the new ones.
Very good, Ashley. Well, looking forward to hearing more about it shortly. Finally, we've got David as well on the line.
Thanks, Jonathan. Hi, everyone. I'm David Cohen. I'm an associate director in the investment team at Allocate. Allocate, for those of you that don't know, are a specialist retail asset manager. We have 30 retail assets across the UK, and our approach is to use data-driven insight to inform everything that we do. We believe that there's a major opportunity to deliver change and create future places that are both sustainable and inclusive for their communities. So I will try and convince some of you that retail isn't all bad today. That will be my task.
Well, I'm looking forward to it, David, and you know, I'd say I am convinced on certain types of retail having a future, but let's move on. And I think you know, from an audience perspective, what we're going to try and ask yourselves today is, if you were investing your personal money in real estate, where would you be investing it? And you know, believe it or not, probably a lot of you already do that, but you might not know. Today, we've now got a compulsory auto-enrolment to workplace pension schemes. So that means your employer, as well as you, probably pay in money to a pension, and probably, can't say for certain, but depending on your scheme, you may or may not be investing in either property funds or property investment trusts. So really, what we want to be asking today in the format of the webinar is, you know, where would you be investing your property pension fund? And I'm going to go around, speak to the experts today, and make this really conversational. And just to flag, there'll be a lot of opportunities to engage. So we're going to have polls, and also at the end, we're going to have an opportunity to ask the audience, well, you as the audience, to ask questions to our experts. So just a couple of facts and figures to get us started. The total investable stock of commercial real estate in the UK is around £1 trillion, and that's according to the the ONS. And that's about half the value of the FTSE 100 index, where a lot of UK pension funds will be focusing their investment. Property is obviously not as liquid asset class, because you've obviously it takes time to trade it, and our experts will probably tell us a bit about that shortly. So only around 500 billion of commercial property is traded a year. So our first question, and I'm going to ask our BPF team to get up the poll, is if today, if you were working for a pension fund, or if you were working for the pension fund you're invested in, where would you spend your 100 million? We've got 4 options. We've got offices, we've got retail, we've got logistics, and then we've also got healthcare. So if possible, if you could do the poll there, that would be great. And just to help you pick through some of the questions and things on your mind and get you thinking like an investor, and I'd like to raise how at Aviva we have one tool called hurdle rates, which help us make better investment decisions. So a hurdle rate is what we decide before we enter into an investment, what the minimum rate of return for that project will be. These hurdle rates are determined for an average asset at a market level, and we're aiming to incorporate risks like currency, like liquidity, how easily it would be to buy or sell this asset going forwards, volatility, how likely the property value is going to go up and down, transparency, how easy is it to get information about the market, and lots of other risks. So riskier projects generally will have a higher hurdle rate, while those with lower rates likely come at lower risk. Can't guarantee that. So mentally, when you're asking yourself the question for this poll, and while you're asking yourself for this poll, then so we've just had a question come in there already, so thank you very much for that. Riskier projects, as I said, generally have a higher hurdle rate. So sorry, is the sound okay for the audience? Sorry about that. Can I ask maybe David if that's all right?
Jack, probably what you'll probably say. Hear a bit of background.
Okay, all right. Okay, well that's really helpful to know. Okay, well firstly let's move on to the sector specialists and ask you. So I'm going to ask you a little bit more about your sectors. David, are you able to start us on that one?
Yeah, sure. Thanks, Jonathan. So there's a huge amount of retail property in the UK, and based on Jonathan's stats of £1 trillion, I think retail probably accounts for about a quarter of that, somewhere around 250 billion pounds. The main types of retail spaces are shopping centres, out of town retail parks, high street retail shops, supermarkets, and factory outlet centres. So there's quite a diverse nature to the sector. I think one of the great things about retail is it's a really relatable sector, because many of you will know a lot of the tenants. There's a lot of good tenants such as Tesco, Sainsbury's, who occupy the supermarkets, through to B&Q, Halfords, who are really strong DIY brands, as well as some good fashion out there as well, like Primark, Next. But then obviously on the other end of the spectrum, there are some tenants you probably try and avoid. This has been a pretty mad week with Debenhams and Arcadia, both going into administration. So, liquidation with Debenhams. So, there's a lot of those tenants speak to us, and we know a lot about them already, which is helpful when you're trying to invest. The lease profile is interesting with retail, and I think it differs quite substantially. On the one hand, supermarkets have long leases, 20, 25-year leases with annual index link rent reviews. So that's a real low risk kind of interesting product for a lot of institutional capital, particularly. And then at the other end of the spectrum are outlet centres, which are based on the turnover that retailers receive and have annual kind of break options. So performance can be monitored, and if it's not quite working, changes can be made to keep that sustainability. And then just talking a bit more about what drives performance in the sector. For me, there's four key factors. The first is location, which is an obvious one, I think, with every property asset. The second being the supply, so how much actual retail space is there in the location, and then thirdly, the particular asset that you're looking at, how dominant is it? Does it account for 10% of the retail space, or does it account for 80% of the retail space? And there's quite a difference in those scenarios. And then the final thing is about the purpose of that asset. So is it the go-to DIY location for the region? Because if that's the case, it's going to have a real strong affiliation with people, and it will have a good performance going forward. But if it's just another retail park or another shopping centre in a quite a competitive field, along with online shopping as well, then it's probably something to try and avoid. So that's a bit of a whistle stop journey through the retail sector.
So this slide just gives you just an idea of what types of assets we have in the primary care sector. So, and the general idea is actually to try and move GPs away from the ones on the top there, those cramped, not fit for purpose premises, and move them into something like the main picture there, which is Cinderford Medical Centre, which we completed this year. But from an investment point of view, probably the most important aspect or the character of this sector is the secure and long dated nature of the income stream. So secure because the rent is underwritten by the NHS. So whilst it's the GPs that will typically sign a lease, the rent is actually government backed. Long dated because typically the leases are 25 years with no breaks. Rent reviews are normally 3 yearly, upward only, to market value or index linked. So what you have is you have that really good visibility on your rental stream for a very long period of time, making it very attractive for income seekers. And this also means we can borrow money at really low rates. We've just secured debt at 1.5%, which is, I think, been told is the lowest rate for any listed property company in the UK ever. That gives you an idea of we couldn't do that without that sort of long dated secure income. But I'll just touch briefly on the demand and supply side as well. So demand, there are some real strong structural tailwinds or secular trends that are helping the sector. So we have more housing, we have an increased population, we have an aging population. As we get older, we develop more complex health needs. And there's a general trend to provide a much wider range of services in the community and away from hospitals, which are bulging at the seams. We're also seeing practices working in larger teams across primary care networks, and more health professionals in one building, meaning larger medical centres. And on the supply side, a recent BMA survey, British Medical Association survey, indicated that 1/2 of GP surgeries are not fit for purpose currently. And they said that 4 out of 5 deemed not fit for the future. So that gives you an idea. I mean, a good proportion of you will have a GP that's based in maybe cramped premises, poor infection control, poor DDA access, and so on. And to put it into context, there are, give or take, in the order of 10,000 surgeries in the UK. We're the biggest landlord in the UK, and we only own 6% of the market. So there's a massive total addressable market there, and a conveyor belt of opportunities that needs capital to invest. I'll just try and
Can you hear me again now? If so, Catherine, I'll ask you to crack on.
Brilliant, thanks. So the logistics sector, I know you'll have all been buying, I assume, lots of parcels through Black Friday and otherwise online, and that's all delivered through the logistics sector. So you're probably all very familiar with it. Just a quick overview in terms of the investment market. So the 3-year rolling average is about 3.32 billion, up from 2.21 billion 5 years ago. You've seen the explosion. You'll have all probably been part of it. And so you have, in terms of your investment opportunities, you have what's called big box. So that's 500,000 square foot to 1 million square foot. They're often national distribution centres, those huge warehouses that you see when you're going down motorways. You'll then have unit sizes about 200 to 500,000 square foot, mid box. Often regional distribution centres, used for manufacturing. And then finally, you've got your up to 100,000 square foot. In the logistics space, that's largely known as last mile hubs or urban logistics. And for that market, you'll see them around big cities and elsewhere, and also inside the M25. Very different market, very expensive for land values, but very high rents. To give you a sort of flavour on that, the recent Q3 CBRE report showed that price or rent per square foot outside of London, it's as low, she says in inverted commas, as about £6 a square foot, but actually more like £7. But then that southwest inside the M25, £16.50. So hugely more expensive. But occupiers are willing to pay because people in the city need their next day deliveries. And need those supplies to come in. So actually, the market, there's lots of opportunities to invest your 100 million in those different spaces. Hugely buoyant. I mentioned Black Friday, but actually COVID has accelerated that whole trend towards investment in the market. In terms of the different types of occupiers, you've got distribution, third-party logistic providers. You have got manufacturing, construction, the motor industry, but retail, as David's already alluded to, the sheer size of that sector, retail accounts for over 50%, and of that, 15% is 37% is online retail, 15% is the retail. So actually, it plays a huge part of the market. It's not all of it, but actually that huge growth in e-commerce we've seen drives that demand. And so in that sense, what's happened is that the supply in the UK market has dropped hugely and continues to drop. More houses that are built, the more logistics and e-commerce space you need. And actually what that means is it drives demand, and for investors, that's his only. So you basically get lease lengths, 15, 20 years. Obviously, short-term arrangements at the start of COVID when we saw all those things in the news about PPE, but actually it's longer term. And the reason for that in the UK is actually because we have got very high-tech, often units, built to suit units. And that technology and that automation inside the unit is often more expensive than the cost of actually building the unit itself. So actually, occupiers invest a huge amount into these assets. There are longer lease terms, and the rents tend to go up, 5-yearly rent reviews. And for those really large investment opportunities, they're RPI linked, very much like Ashley said, but that provides steady, stable income in a sector that is only growing, and which makes logistics really attractive.
Oh, thanks very much. Yeah, no, I can speak from experience as someone that made a few Black Friday weekend purchases. I see that they've sort of expanded that out now over quite a few number of days to sort of capture that extra demand. No, it's really interesting to hear. And thanks very much. So let's move into talking about the actual investment characteristics and sort of dig a little bit deeper into those sectors. So I'm going to go to Ashley first and ask, ask the whole panel the same question. What are the return expectations, and what are the risks, the key risks to those expectations?
Yeah, okay. I think the first thing to say is probably that it's quite difficult to predict the future returns, isn't it, with any kind of accuracy. I think what investing in primary care gives you is a few things that other sectors don't. So the first thing, as I mentioned at the beginning, was that secure, long-dated income that enables us, for example, to provide a progressive dividend policy. So typically our dividend yield is around 3.5 to 4.5%, depending on the market cap at the time. But and if dividends are reinvested, then clearly you can have the magic of compounding over time. I think one of the most important points is the risk-adjusted returns. There's quite a lot of research on this, but it's actually a fallacy that you need to take high risks in order to generate high returns. The IPD and the MSCI publish data on this, and we often sort of bring this graph out, to investor presentations, and basically it maps returns against risks for each sector, and the returns for primary care over the last 13 years, which is when they started taking the data, have been actually higher than industrial and retail through that whole period. The only thing that was higher in the whole of the property sector was residential. But the key point is that you're taking less risk in order to get that return. So it's a risk-adjusted return. The other thing is volatility. To be honest, we're not immune to everything. But I think what we are certainly well insulated is we're well insulated against certain things like economic downturns. We're not as cyclical as the other sectors. Changes of government, across all parties, they're pretty much supportive of what type of thing we're doing and investing in primary care. Brexit is something that affects everyone, I suppose, but again, we're a little bit more insulated. Pandemics, we've been affected a little bit, but I think we're probably more resilient to the sectors in those respects. But I think my kind of trump card really for investing in primary care is social impact. So one of the nice things about working in primary care is that we can actually have a massive positive effect on areas of high deprivation and health needs. So these are areas that often don't benefit from investors' capital. A medical centre typically serves about 10 to 20,000 patients. So it's just nice to be able to develop a building that has a tangible benefit on people in that community and can make a real difference to people's lives.
That's great. That's great to hear. Yeah, and I really like your approach of taking risk into account and looking at risk-adjusted returns. And I really emphasise the audience to think like that. Okay, so if we could move back to Catherine now, it'd be really interesting to hear your answer to the same question. What are the expected returns and what are the risks?
So, the returns are pretty stable, really, in the logistics sector, particularly prime distribution. So you have a yield of around 4% upwards, about 4.25% generally. They're stable because they are seen as institutional, acceptable. They have good returns in that sense. In terms of actually developing the portfolio and making more, you can't work the asset as much, but it's stable. And for an investment, you can keep it there and you can utilize, it's safe and secure for that period. It's also quite resilient to the risks. So pandemic-wise, we've actually seen that growth in e-commerce, and actually the view is that will stay. It's fluctuated a bit, it dropped off a bit earlier in the year, and it's grown again. Black Friday has been a phenomenon over the last few years that's grown. So actually, that demand is there, and as I mentioned before, the lack of supply means that there are really good investment opportunities in the sector. In terms of other risks, I guess, as we've seen in retail, and as David touched on, it's been a bit tricky recently. We see in the news Debenhams and Arcadia, they've all got an awful lot of logistics space in the UK. And again, I guess it's in the case of all investment classes is who are your tenants and your occupiers. Less so for Ashley, and I completely take that in terms of that risk profile. But the returns arguably are slightly better. And so in that sense, it's just looking out for those corporate occupiers. But what I would say is those online retailers, they're growing in their demand and need. And actually, so in terms of those risks and mitigations, you're not as exposed in the logistics sector, which is a really good thing from an investor perspective. And also one thing to point out, I can't compete with the trump card of Ashley with the community impact side of things. But what I would say is that the growth in logistics, it was once seen as a very dirty industry, and actually that's not the case anymore. You know, you have units going up, and it's got 180,000 square foot of office space in it, and that's because they're high tech with very skilled jobs now. So actually the industry's changed, and it can provide a whole new skill set and quality jobs for those in that industry. So it has not the same community impact for members at large, but actually some really good employment opportunities as well in the sector.
Just to kind of jump in on retail, because I don't think I can really hand on heart compete with the returns that have been seen in industrial and healthcare over the last few years, particularly. But you know, I think maybe we were all too young, but retail was the darling of the property sector 20 years ago, and returns were at the top of the market then. So things are cyclical. Healthcare and industrial are going through a good spot right now, but whether that continues, like Ashley mentioned, we don't know what the future holds. But again, with retail, like Ashley said, it really is about risk-adjusted returns, and there's obviously quite a lot of risk to be mindful of. Notably CVAs, administrations, and just the income profile of assets. There's a lot of over rent there, and there's pressure around the occupation of tenants and who will fill the space if a tenant does leave. But the retail market is very layered, and on one scale there's the food stores which have performed exceptionally well over COVID and have all the ingredients for pardon the pun, but all the ingredients for a strong future, given the need for food and just the location that they hold, the fact that they're very they're able to work very well alongside online from a logistics perspective, and also from a kind of click and collect consumer basis. So that's still seeing institutional capital, and that then drives the pricing. It is really about who's the investor out there, what kind of returns do they want. Whereas on the other end of the spectrum, some shopping centres and retail parks that are, let's say not in such a good position, or their future it still remains uncertain. We have a lot more, we don't have the institutional capital there anymore. It's all opportunistic, vulture funds kind of circling, trying to get the best deal that they can. And given the risks that are in place, they're really targeting high returns. In terms of IRR numbers or equity multiples, it's more than 2 times the money that they invest, they're looking to get back. And an IRR of 20-25% over a 5-year period. So it's targeting strong returns, but obviously if those business plans do come off, then it can be lucrative. So it's about being mindful of the risks, managing those as best you can, and that could be through when you underwrite an asset, you're not looking at just what the picture has been presented to you. It's going a layer beneath that and saying, what's the sustainable position here? In an extreme case, it might be demolishing half of the shopping centre and, you know, having a site that you can put a healthcare GP service on, or you know, your retail park might be a future industrial estate. So it's having that mindset, and given the distress that's in the market, there are these opportunities out there that you can start to pick off at attractive pricing.
It's really interesting, David, and I think it's worth just reminding the audience of something Catherine said there, and low stable returns, sort of 4%, 5% yield for prime distribution units. That's akin to supermarkets. So you'll be getting the same sorts of covenants, potentially even better in supermarkets for very similar, if not better, returns in the retail sector. And then as David's quite rightly highlighted, the retail sector's had negative returns in the last few years, but now have we reached the bottom? And are we looking to have double-digit IRRs, 20% IRRs? And do you that actually sounds like quite a attractive investment opportunity for my pension. Getting 20% IRR, which is an internal rate of return on an investment, so a 20% return on investment. So it's not quite as simple as just investing with the trend. So thanks for that. Now, just a quick fire round. We've had a couple of questions come in. I'm keen to leave time at the end. So just a real quick fire round. Just going to go first to Catherine. Are there any, and this goes to everybody on the panel, are there any specific skills that are needed to create successful investments within logistics, and then the other sectors, for the other gentlemen?
I guess logistics doesn't need as much managing as some of the other sectors. So in that sense, to create value, there's two opportunities to invest. You can do so at the very early forward funded stage, so developments and which haven't yet been constructed, and where you forward fund at that early stage. You take a bit of risk on planning, potentially risk on the build and the costs, but ultimately you can drive better returns from that. You can do so even more through speculative development. So you haven't got a tenant lined up, and then you start to fund the developer building, and you find a tenant before your unit comes to practical completion, as I say, and you can again get an enhanced return in relation to that. Or you can buy once it's been let, and you buy effectively 15 years of bond-like income. So nice, steady, coming in every year income from some really good covenants. So in that sense, depends at what stage you come into as to what skills you need. I mean, I think it's the same, maybe not so much with Ashley, but it comes down to covenant strength and getting the right occupier. But as we've seen, it's a really secure market in that sense, because demand is only going up and e-commerce is going up, and they are your occupiers. So I think perhaps some less skills than in other sectors, but there's certain opportunities out there.
Oh, very, very, very good. Back to David then. How about the retail sector? What skills would you need to be a successful investor in that area?
Yeah, I think retail is definitely one where you need specialist advice today, given the headwinds in the sector. Firstly, it's just being able to sift through and identify, which assets are going to be the winners and which are going to be the losers of the structural change that is currently happening. And given retail is, it's very much an operational asset class today. Take maybe supermarkets slightly away from that, but then there's assets that really need to be managed. They're kind of in the same way as a hotel or a student accommodation scheme. You wouldn't buy those unless they had customer service teams, reception, bookings teams. Really with retail, you need to have every base covered, and you need to have a team that can, has that platform in place. And I think the final thing I'd say is just on an exit strategy, because when we buy investments, you actually don't make your return until you sell it. You can kind of you project what you think it would be, but really the the D-Day is when you sell it, unless you know what your overall return is. And with retail, you know, it's been hard to sell assets, you know, over the recent years. Allandi have been successful in selling 10 assets since 2018, and the way we've managed to capture that appetite is being creative, really, and just seeing what is the best source of liquidity out there for each particular asset. It could be creating a development site. It could be selling to the local authority, or maybe you know, a bit more of a traditional private institutional type of buyer.
I think for me, it's really similar to David and also Kathy. To be quite honest, you know, you need the sort of same set of skills for development in primary care as you do for development in retail or logistics. The one sort of quality I think you do need in my sector is patience, because you're dealing with the NHS, which is a beast, and you're also dealing with individual groups of GPs. Someone described it as herding cats. You know, property can be quite alien to people who aren't used to it, and it's kind of dealing with people who aren't used to commercial deals or property deals. So it can be quite challenging in that way, and it can move quite slowly. There's also no market for speculative new build developments. You know, you don't have people coming along and just building like you would a shed. You wouldn't build a medical centre and then try and find a tenant afterwards. It just doesn't work like that, because everything needs to be bespoke for that particular area, and it needs the GPs on board right at the beginning, and all NHS approvals are a prerequisite. But I mean, apart from patience, it's, you know, from our point of view, it's about being a long-term partner to the NHS and responding to what they need, but not only for new developments, but also for existing assets. So I might have painted a bit of a picture of, you know, boring long-term income that you can just leave, but actually that's not the case. There's so many asset enhancement initiatives that we love to get our hands dirty on. You know, lease re-gears, extensions, fit outs of vacant space, reconfiguring space, and in fact these sort of types of activities have the highest return on capital for us. But it's not always about just simply the financial. It's actually about having that social impact angle or environmental angle. So, for example, we've, you know, changed medical centres to put LED lighting in them, or PV on the roof. We've done an allotment alongside a charity on one medical centre where we're trying to promote healthy eating and tackle isolation. So there's loads of stuff that we do with our assets.
Oh, that's really interesting. Actually, we've actually had a couple of questions come in on already around ESG. So we'll come back to tackle that topic in a minute. You know, I think it's been really great to hear so much about all of your specific areas. And so probably best now, in the interest of time, to actually move on to the questions at the end from the audience, and you know, bring the webinar shortly to a close. The first question I've got is to Catherine, and is about the future. So just really quickly, you know, how, you know, world's obviously changed quite significantly in 2020. You know, just to Catherine, how is this going to impact the logistics sector over the next five or so years?
In terms of the logistics sector, I think we can only see e-commerce growing, the need for distribution growing. The more we build houses in the UK, the more distribution space, and there's some staggering figures on that you need an extra 69 square foot for every house you build. So the bigger the housing targets in the UK, the more logistics space you need. So over the 5 years, I can only see it growing in that sense. There is a big movement, and I know we'll come on to it in terms of sustainability, but Ashley made a really good point. The drive is to improve the other enhancements around logistics. So those welfare facilities for staff, the green initiatives are really big. So PVs on the roofs, very much so. But also the sense of needing to retain labour and train up labour. That's a huge thing within the logistics sector. that developers and investors and occupiers are all looking at the moment. So I think we'll see that increased sort of holistic placemaking, you call it in retail, but that's a very big thing on logistics parks and making those sustainable and great for welfare for those that work there.
Yeah, that's a great response. That's a great response. We've got a question here. Another question come in. This goes to David, and it's about tier 2 cities and retail in the suburbs. And the question is retail attractive or not attractive in sort of tier 2 cities and the sort of growing suburbs? I guess that's in a result of. There's been a lot of press of people moving out of cities at the moment recently.
Yeah, I think it comes back to what I mentioned earlier, where in terms of supply of retail space and the location, what the purpose of the asset is, and how dominant that asset is. So there's some very good local convenience suburban schemes. That will, they have affordable rents and they have a really strong purpose to play. They might have a grocery anchor to them. On the other side, cities, they're the hotbed of communities, and they occupy really valuable land in many cases. And yes, it could be that the retail is there today. Whether some of that retail is needed in the future or all of it is, again, going through that process of understanding the specific market. But what's great about cities is that if the retail is perhaps not so strong and there's too much of it, then it's a site that is in demand from many other uses. So it has value. It's got a strong intrinsic value. But it might not be retail. It's hard to generalize because I think each place is very unique, and you need to really understand what that location needs. We've got so many ghost towns and so many towns that look exactly the same that that's not worked, and we need to kind of move away from that and really come back to what the community needs and try to deliver that.
I would echo that as well, and just to say, David, actually we're working with a retail investor trying to incorporate a medical centre within a kind of I suppose a declining secondary shopping centre. So something where it's really struggling, and actually by bringing the medical centre into it, we're going to, and then creating a bit of a public realm, we're going to work together and trying to create a much better environment.
I guess also from a logistics perspective, this is more in the southwest again, but looking at some retail parks where they can be used for last mile logistics, where it's really hard to get land. The numbers only work within the M25, but that's a repurposing also of the of retail. Although ironically, I think retail parks have done well out of COVID, so maybe that'll slightly change.
Yeah, yes, interesting debate, really, isn't it? So we've got another question, and I'll direct this again on climate. I'll direct this to David. We've got two questions. First one I'll answer. But second one, so David, just give you a bit of time to answer. How important is climate resilience in your decision making? We sort of heard about ESG from the other two, and then finally we've had a question on what's the panel's view on offices. And that's a really great question, particularly as I'm in one today, as lockdown has sort of opened up in parts of England. I think and apologies earlier for some perhaps background noise on the call. So thanks for bearing with us. I think a lot of people have raised the question. Are we going to be working from home quite a lot from now on? And I think. As a real estate researcher, I think our view is yes, people are going to be demanding, as a result of COVID, more flexible working arrangements. So they might go from, working half a day on average, or 1 day a week on average from home, to, up to two or three. I think what we are doing and where we're focusing our investment and where we see resilience is in the top quality locations. So echoes a bit to David in that not all offices are made the same, and really where we see value is when offices can bring people together to collaborate. So with meeting rooms, lots of amenity space, almost like hotels, destinations. So it gives you a reason to leave your home and spend time with others and collaborate and innovate. And that's where we're focusing our investment. We really think London is really well placed in a global context for that, but a lot of the other UK big cities as well. And where we'd be a bit more cautious is on space that's perhaps let occupiers that compete on costs or want cheap space, maybe call centres or something like that perhaps could their activities could move to a virtual environment. So final question, and I'm gonna, while Dave is responding to the question about sustainability, I'm going to ask for another poll to come up to see how people have changed their minds. I know it was very strong for one area, which I won't remind anyone of to start off with, but I'll just get the BPF team to put the other poll up there, and then David, just out of interest, how are you responding to the climate emergency in the retail sector?
Yeah, it's a really big topic at the moment in retail, and there's been a few institutional clients actually raising ESG funds. So it's certainly a growing area. I think it works across the spectrum from customers providing space that is part of the community where they can come and feel part of the location, not just as a shopper, but also having opportunities to work. And as Ashley said, it's providing that need to those that need it most in terms of the services that are demanded in that location. And then on the other end of the spectrum, it's the kind of the ESG environmental impacts. And yes, we are very keen, and a key strategy for us has always been to try and deliver green solutions, whether that's LED lighting or just improved performance. And not just because it's great for us, but it's what as well as tenants are also keen in having those kind of solutions, and everyone I think is on board with that. So it's very much at the forefront of what we're trying to do and creating those sustainable places going forward.
Similar to medical centres really as well. We're trying to make sustainability the heart of what we do. We're going to be owning these medical centres for 25 plus years, trying to make them more cost effective for the doctors, lower running costs. We're actually going to be doing our first net zero carbon medical centre, which we've kind of embarked on it this year with our design team, and we've realised it's quite hard actually, because you've got so much mechanical and electrical kit in these buildings, ventilation and all sorts, that it's actually a real challenge, but we are committed to doing it.
I think looking forwards, environmental, societal, and governance issues are going to be absolutely at the forefront of personal investing decisions. I think there's been a real change in mindset from young people and governments in the last couple of years around this. So it's really great to hear that you're all so focused on that within the sector. And it's clear from the audience, probably we've had over 10 questions come in, and the majority of them have been around that issue. So it's really great to have that. So apologies to everybody. We've gone slightly over time, but I think it's been an absolutely excellent discussion. And if I was to just wrap up, we had a poll at the start we had a poll at the start where we asked what you would be focused on investing, and logistics won out on that one. And the poll at the end, I don't know if you can see the answers as well as me, but logistics still wins. But what I will say is well done to Ashley and David, because your percentage numbers have gone up. So you've chipped away at Catherine. But Catherine, you are the winner for today. So very well done in this very small sort of competition we've got here. And as I sort of work and advise on quite a lot of pension funds, so you and Mai's pension money, we're actually about to launch our second real assets house view, where we look at relative value across infrastructure, real estate, all different asset classes within real assets. And the key conclusion, a bit of a spoiler alert, coming out next year, which please get in touch if you'd like a copy. The long lease real estate is the sector that we see as being best value at the moment. And it's notable that all of our panel members have talked about how you can access long leases within their sector. So whether that's supermarkets, whether that's distribution warehouses, or Ashley's sort of doctor and medical surgeries, and actually that it's clear from our analysis that the length of the income is actually the most important element to getting strong risk-adjusted returns. So I think I wouldn't talk down any sector, but I'd certainly talk up pockets in all of the areas. So that's been really useful. So thank you very much for everybody who's joined today, and apologies for some technical issues at the start. Thank you very much to the panel for all the insightful comments. I've learned a lot. It's been really useful. And thank you very much to the BPF, so Murray and Kirsty specifically, for helping organise this session. Stay tuned for the next BPF event coming your way soon. Thanks very much. Bye.